Hello, welcome to the next in our series of videos on IFRS 9 for corporates. I'm Sandra Thompson. I lead our global accounting technical team for financial instruments. I'm delighted to be here today with Holger Meurer. Holger's on secondment to my team from our German firm, which helps our clients there. Today we're going to talk about IFRS 9's impairment requirements. Now this is one of the biggest changes between IAS 39 and IFRS 9. Under IAS 39 today, companies use an incurred loss model. That basically means that something needs to have got worse in order for an impairment to be recognised. For example, a debtor doesn't pay on time or their financial condition has deteriorated. Under IFRS 9, we move into an expected loss model. This is likely to result in impairment losses being booked sooner and also for the amount to be more volatile. The other key thing to note up front is that IFRS 9 actually has two models for impairment. What's called the general model and then what we're going to call the simplified approach. And that latter approach will be highly relevant for corporates. And we're going to talk you through them both. So Holger, let's kick off with the general model. Can you tell us how it works?
Yeah, sure, thanks Sandra. Well, under the general model, any financial asset is initially in stage 1. For those instruments in stage 1, IFRS 9 requires a loss allowance equal to 12 months expected credit losses. This means that for those instruments, other than today, there is some sort of impairment already at day 1. For trade receivables, the combination of IFRS 9 and IFRS 15 even results in a sort of a double hit to income statement from both discounting the amount due and this day 1 impairment loss under IFRS 9. If then later on there is a significant increase in credit risk, then the financial asset moves from stage 1 to stage 2. The consequence of this move is that now the loss allowance is no longer 12 months expected credit losses, but lifetime expected credit losses. This may result in quite a big step up in the amount of loss that is recorded. So under the general model, it's due to this quite important when there is a significant increase in credit risk and when actually the asset moves from stage 1 to stage 2. This cliff is avoided in the simplified approach. So under the simplified approach, you don't have this cliff. But Sandra, could you perhaps tell us a bit more about how the simplified approach works?
Yes, thanks Holger, I will. So the simplified approach is to always recognise a lifetime expected loss. Now this is simpler because you don't have to determine if there's been this significant increase in credit risk and when you've fallen off the cliff, as you so nicely called it. So therefore it's easier to apply. However, you do still get this day 1 loss. In the case of the simplified approach, it's a lifetime loss, so it's likely to be bigger than under the general model, and that's a downside. It's important to know that the simplified approach can only be used for some kinds of assets. Those are trade receivables, contract assets that arise from the new revenue standard IFRS 15, and lease receivables. Let's start with trade receivables. For trade receivables, there's a further distinction in the standard. So for trade receivables that don't have a significant financing component, and that often as a rule of thumb means trade receivables of a year or less to run, then you have to use a simplified approach. So you have to measure lifetime loss. But in that case, 12-month and lifetime loss is likely to be the same in any event. For those trade receivables that do have a significant financing component, then an entity has a policy choice. It can either use a simplified approach, lifetime loss throughout, or it can use a general model and do a significant increase in credit risk that pushes you into lifetime loss. That policy choice has to be made for all trade receivables together. If we move next to contract assets that arise under IFRS 15, they're basically the same as trade receivables. So if a contract asset does not have a significant financing component, you have to use a simplified approach, lifetime loss. On the other hand, if a contract asset does have a significant financing component, you have the policy choice between the simplified approach or the more general, more complicated model. And finally, lease receivables. For lease receivables, an entity always has a policy choice between which of the two models to use. So Holger, I think we've touched on this already, but when a company makes up its mind where it has a choice which to go for, what should it bear in mind?
Well, I think as you mentioned before, I think the key question is really whether you want to have a simplified approach without having to do this movement from stage 1 to stage 2 and this assessment of whether this step has to be taken and whether they are willing to accept the price having this lifetime expected credit losses. So I think this is really the key balance they have to take, simplified on one hand versus higher or larger credit losses. So I think that's really the question they have to take. But I mean, even if they go to the general model, I think there are still some strategies that could not make life easier. So, I mean, yes, it might be complex on the first sight to assess when to go from stage 1 to stage 2, but I think there are some strategies who could help entities.
So you can tell us a bit more about what those practical approaches might be. How in practice will corporates assess significant increase in credit risk?
Yeah. Well, I think, first of all, it's not always necessary for corporates just to have those complex statistical models and these credit ratings. Often it will already work if they use some qualitative, non-statistical information. So IFRS 9 provides quite a number of qualitative factors that should be taken into account and that may indicate that there is a significant increase in credit risk. So one example would be the debtor's performance, the debtor's operating results and its expectation for the future. Another example would be the changes in the economical or technical environment in which the debtor operates. Another thing that could also be used is some external market indicators, like, for example, credit spread, if they are available. So any of those could indicate that there is a significant increase in credit risk and that it's time to move to stage 2. Another thing that might be quite helpful is past due information. So past due information, of course, shouldn't be the only information that is used. So if there's forward-looking information available that is reasonable and supportable, then of course this should be used. But nevertheless, past due information can be a hint, can be something that helps. And in IFRS 9, there's this rebuttable presumption that if a payment is past due for more than 30 days, then there is a significant increase in credit risk. It's however worth noting that this rebuttable presumption for the 30 days is only a sort of a backstop. So it's the latest point in time in which we assume that there is a significant increase in credit risk. In many cases, it will already happen earlier. So I think these are two of the main exemptions or two of the main things that really could help corporates to have an easier life if they decide to use a general model.
Thanks, Holger. Some really good practical advice in there for our clients. So just to recap, IAS 39's impairment requirements move from today's incurred loss model to an expected loss model. One of the key features is that there will now be an impairment loss from day one for all financial assets, debt securities, trade receivables, etc. In the case of trade receivables, you get this double hit that Holger referred to. So you get both the day one impairment loss, but you also have to discount, and that means that the amount recognised for your receivable is less than what's due. For many of the assets that corporates will hold, in particular trade receivables, contract assets and lease receivables, you actually may have a choice between doing the model that Holger outlined or the simplified approach. And in making that choice, you have to balance a simpler model against probably a bigger and more volatile provision. And of course, for those assets which don't qualify for the simplified approach, you have to use a general approach. And no matter which model the corporate chooses, it will then have to measure the expected credit loss. And that's something we're going to talk about more in our next video. Thanks for watching today. I hope you'll join us next time. If you'd like to subscribe for the whole series, please click on the button at the bottom of your screen. Bye-bye.